The massive collapse of multi-billion-dollar crypto exchange FTX has grabbed headlines, spooked investors, and turned its former CEO Sam Bankman-Fried from so-called wonderkin to pariah in just weeks. But among the carnage, at least one major bank sees a buying opportunity: Goldman Sachs. Reuters has learned exclusively that Goldman plans to spend tens of millions of dollars scooping up or taking stakes in beaten-down crypto companies. With investor interest dampened, those companies can now come relatively cheap for those who are still crypto believers, which, apparently, Goldman Sachs is. The bank's head of digital assets told Reuters that Goldman is doing due diligence on a number of different crypto firms, adding that while FTX set back market sentiment, crypto's underlying technology, quote, continues to perform. But rival banks are more skeptical, especially as calls mount for heightened regulation. At a Reuters Next conference on December 1st, Morgan Stanley CEO James Gorman said that while he didn't think cryptocurrencies were going away, he couldn't, quote, put an intrinsic value on it. And HSBC CEO Noel Quinn told a banking conference in London last week he has no plans to expand into crypto trading or investing for retail customers. While the amount Goldman may spend is not large for the Wall Street giant, which earned $21.6 billion last year, its willingness to keep investing in the sector amid the shakeout shows it senses a long-term opportunity.
At least 20 oil tankers travelling from Russia and waiting in line off Turkey face more delays. That's according to industry sources. The ships were waiting to cross from Russia's Black Sea ports to the Mediterranean as of Tuesday. It comes as operators race to follow new Turkish insurance rules added ahead of a G7 price cap on Russian oil. Turkish authorities issued a notice last month asking for more guarantees from insurers that would cover ships moving through the Bosphorus from December 2nd. The new rule was announced before a $60 per barrel price cap was imposed on Russian seaborne crude this week. Western insurers are required to show proof that Russian oil is sold at or below that price. The industry has a 90-day grace period to comply with the G7 plan. A source told Reuters there will be further delays if owners or operators can't provide the required guarantees. Millions of barrels of oil per day move from Russian ports through Turkey's Bosphorus and Dardanelles Straits into the Mediterranean. Shipping agency GAC said the average waiting time southbound at the Bosphorus on Tuesday was 4 days for vessels longer than 200 meters. That's up from 1 day in mid-November.
Wall Street ended lower on Tuesday, with the S&P 500 extending its losing streak to 4 sessions as skittish investors fretted over Federal Reserve rate hikes and further talk of a looming recession. The Dow fell more than 1%, the S&P dropped over 1.4%, while the Nasdaq shed 2%. Tim Courtney is Chief Investment Officer at Exential Wealth Advisors.
I think what we're seeing in markets today is the continuation of the interest rate story that started, at the end of the first quarter this year. And that means those most interest rate sensitive areas of the market, like the Nasdaq, like large growth stocks, they're falling more. They're falling more today. They fell more yesterday. If you're more sensitive to interest rates, you've had a bad day over the last couple of days.
Among those large growth stocks, Apple, Amazon.com, and Alphabet all fell between 2.5% and 3%. But it was Meta Platforms that really dragged down markets, its shares sliding 6.8% following reports that European Union regulators have ruled the company should not require users to agree to personalized ads based on their digital activity. Financial titans also pointed toward uncertain times ahead. Bank of America's chief executive Brian Moynihan predicted 3/4 of mild negative growth next year, while J.P. Morgan Chase CEO Jamie Dimon said inflation will erode consumer spending power and that a mild to more pronounced recession was likely ahead.